As a day trader, what you need to do first is to understand that you day trade, and if you're day trading, you must close your position within several minutes or several hours, and it mustn't pass the 24 hours, like cross to the next day. Okay. So what I do first when I open the chart and I want to analyze, because today is Sunday, 13th April 2025, and I want to analyze the USJPY that will be opening in a couple of hours. All right, so the first thing on my checklist is to mark the key levels from the daily time frame. From the top here, you can see this is a daily time frame, right? So I mark out the key levels. The key level is where you have support and resistance, where you have areas of key touches. When you have multiple touches in certain areas, you mark it out. Okay, like this part, you can see multiple touches of the candles, both the buy candles and the sell candles, touches here, same as this place, same here. All these are my key levels, right? I can also mark my key levels here as well. Yeah, I can use here as my key levels. These are another touches, 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 touches. So you can mark as plenty as you like, but make sure that they're kind of reasonable marks, all right, or reasonable draws, so you won't be too confused. So after marking the key levels, okay, let's mark another key levels here. Then that'll be all with the marking of the key levels. Okay, that's all with marking of the key levels. I'm done with my marking of the key levels. The next thing is to go down to the 4 hours time frame. When you go down to the 4 hours time frame, you tend to see that what you've marked, when you check the past or the history of the prices where you've marked, you discover that there are kind of areas of concentration or areas where the price actually represents, or the price actually respects. So we can see respect of prices at this point, respect of prices here, respect of prices here, respect of prices here, respect of prices here. You can see the number of touches I'm saying, right? You can see multiple touches, multiple touches. Down here too, you can see first touches, multiple touches here, multiple crossing, steady touch. You can see multiple touches, multiple touches, multiple touches as well. Multiple touches here, multiple touches, multiple touches. So you should know that identifying multiple touches in your daily time frame, I'm gonna give you like a sketch of how it's gonna be like. And the multiple touches is basically where you have support and resistance, maybe when you have supply and demand zones and the likes. It becomes clearer when you go down to your 4 hour time frame. You understand? So in your 4 hour time frame, you might actually see that you can find supply zone, like from this axis here. This is a supply zone, right? An extreme supply zone. Then extreme supply zone, 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 extreme supply zone. This is actually equal highs. This very one. So this is an extreme supply zone as well. Okay. Okay. So okay, trying to bring this together. Okay, extreme supply zone, equal highs. This is the first one. This is the second one here. So okay, let's just leave that. All right, so these are the key levels I marked in the 1 hour time frame. I'll still go to the 1 hour time frame, but so I see it clearly. So sometimes the reason why you need to mark out your levels and also mark out supply or demand zone is for you to know what you're going to work with in case when the price actually opens. Okay, so when you can see uptrend in 4 hour, when you go down to the 1 hour, you see that this particular uptrend, this very long candle, is actually before the candle after it. The candle that's formed currently is an imbalance. Okay, and when you see an imbalance like this, what you expect is that for the imbalance to be balanced. So for it to be balanced, you must have a counter candle, you must have a counter sell because it's a buy, and you must have a counter sell for it to be balanced. Same as this point here. it went up, right? It's creating a very long candle to the top, ending here. Then you have a counter sell, that's counter candles to cancel out this. That's to create the sell, you know, from here now we have another demand here, taking it to the top. Here we have another supply, taking it here. Now from here we have a small demand stopping at this point before reversing to the down part. Okay, and you can see the candles. If you trace it to the back, you can see consolidations, right, ranging from like that. All right, we're not going there currently, so just want to stick to our analysis. Okay, we've already identified the key levels from the 1 hour candle. Now let's go back to from the daily candle rather. Let's go back to the 1 hour chart. All right, so from the 1 hour chart, you see that the circles I drew in the 4 hour candles, or you saw in the 4 hour candles, are kind of matches with exactly where they are meant to be in the 1 hour candle. So from your 1 hour candle, this is where you need to apply. You may actually apply your SMC concept in your 4 hour candle. You cannot try, but it will be more reasonable when you apply it in your 1 hour candle. Okay, depending on how you're looking at things. Okay, all right, now what can you identify from this chart here? You can identify that the chart has supply right here, supply right here, supply right here, supply zone, supply. You can see this supply, but to the down part, creating demand, go to the top, supply, the two supply meets equal highs, right, to create equal supplies down to the down part. All right, now what you see after that is that when you're analyzing, okay, this is just technically top-down analysis. When you're analyzing, you look at the point of interest that is closer to the current price. Okay, the current price, or the price closed at 143.32. Okay, 0.52 rather. This is where it closed, right? Closed at this point. 143.52. Now, this is where the price closes, right? And I drew this level from my daily candle, right? This is my key levels from the daily chart, all right? So my area of interest is that I have liquidity at this bottom, right? I have liquidity at the same candle here. I have liquidity here. I have liquidity here. Okay, now I can basically draw my support line at this point. This is going to create my support line. Okay, this is my support line. All right, I'm assuming that the chart is ranging in 4 hour and also in 1 hour, right? As I'm drawing a support line. So what I expect, this point is this parts, these down parts with the circles are my area of interest, or my point of interest, where the price is likely to come to before taking another intentional move. All right, so that's like the area of interest, right? So I want to draw what I'll call the order block. Okay, this is my order block, and my order block is when you have orders that pushes to the top or pushes to the bottom. Okay, you can see a block like this. Let's just use this last candle. I'm using the complete wick. That's this very candle here. That's what I'm using. So that's my order block. Because after that, it pushes to the top. Okay, I can equally use this as another order block. Okay, from 1 hour chart. Do you understand? So what I'm expecting is that when I go and when I trim my time frame to the 15-minute chart, I'm expecting a bounce. I'm expecting a penetration into this block, right? To fill up all the liquidity that we've identified here, this liquidity, and this liquidity. This very candle coming into this other block and bouncing to the top. That is what I am expecting. Okay, if that doesn't happen, it can actually bounce from the top of the other block and move to the upside. Now, when it moves to the upside, remember that these red lines are my key levels from the daily chart. So if it gets to this key level, there's a possibility it's going to retrace back or continue the move. How are you going to do that is when you use your Fibonacci retracement tool. So knowing when to analyze and how to analyze price is going to be like give you a particular edge in the trading system. So with these, it's not trading time yet. We still have a couple of hours to trade. What I'm going to do is I wait for the price. I can't sell even if it's on, even if the price is on. I wait for the price to test what I've already, the trap that I've already laid out for it. So come in here, take a bounce and go to the top. If it doesn't take a bounce, that means penetrating and coming to touch this support line. Okay, you can touch this support line or pass through the support line. So when it passes through the support line, it's not respecting any of the traps that I've set for it. So the trap is where I want the price to come into, then I take my advantage. All right, let's go to the 15 minutes time frame to see what actually plays out or what's actually playing out. Okay, good. It's more clearly now. It's more clear right now. It's more clearly shown. You can see the circles I drew. They are making sense right now. So I'm still maintaining the other blocks from the 1 hour. I hope you understand. This very other block that I put here, I'm still maintaining it. If you like, you can stream it down, okay, so that you won't be too occupied or you won't be too trapped in or trapped out from the liquidity. But it's coming to sweep this liquidity because there's a huge amount of money. There are huge sales here. Huge buys here. So stop losses are here, stop losses are here, stop losses are here. People that have bought from this particular day to the top here, there are a lot of stop losses here, a lot of stop losses here, a lot of stop losses here. So what happened during the Asian time? What happened during the Asian time is Asian session comes to form liquidity, you know, trap the liquidity. London time comes in to grab all the liquidity, you know. Asian form the liquidity, London grab the liquidity by doing fake outs, breakout and all. Then the original move starts in the New York session. So with this explanation, I'm expecting the price to come and tap this zone to sweep the last liquidity, okay, before advancing to the top. If it doesn't do that, that means it's actually going to come from this point here and cross through the first liquidity, second liquidity, the third liquidity, and likely to stop at this point before advancing to the top. Okay, so that is the simple way to use the top-down analysis using the order block as an example. Thank you so much for your time. See you once again. My name is Pash on air.